The Bank of Canada made its first announcement of 2026. And as many of us expected, they're holding steady at 2.25%. While the headlines might call this boring, for institutional investors, it's a critical signal. I'm Mit Perin, Trustee at Foundation Capital Private Real Estate Trust. And today, I'm breaking down why this rate hold is actually the green light the Ontario real estate market has been waiting for, and how we're positioning Foundation Capital to lead through this period of stability. Governor Macklem is playing a tactical game. With inflation sitting around 2.4% and unemployment ticking up to 6.8%, the Bank of Canada is in a wait-and-see mode. They've already cut rates significantly from the 5% peak we saw back in 2024. By holding today, they're letting those previous cuts finish working through the system. They're also keeping some dry powder in case trade negotiations later this year create new waves. For us, this means the neutral range is officially here. The era of high volatility rate swings is behind us for now. So what does a hold mean for a private real estate trust like ours? Predictability and underwriting. At Foundation Capital, we can now underwrite our new acquisitions with a much more higher degree of certainty. We aren't guessing where the floor is anymore, we're standing on it. With the Bank of Canada holding, we expect the bond yields to stay range bound. That allows us to secure stable long-term financing for our multifamily assets in key growth hubs like London and the surrounding area. In a flat rate environment, you can't rely on cap rate compression alone to grow value. You need active management. That is where our value add strategy really shines. We aren't just waiting for the market to lift us. We're creating value through renovations, operational efficiencies, and professionalized management. A lot of retail investors wait for a drop to enter the market, but by then the competition has already bid up the price. The smart money moves during the hold. We're seeing a window right now where sellers have adjusted their expectations, but the buying frenzy hasn't fully kicked in yet. We're currently looking at several high-density residential opportunities that hit our target of 7% annual distributions and 12 to 15% total returns, specifically because we're moving while others are sitting on the sidelines. Stability isn't a reason to wait, it's a reason to execute. At Foundation Capital, our mission is to provide institutional-grade real estate access to our investors. This 2.25% environment is exactly where our model thrives. If you want to see our current portfolio or learn more about how we're navigating the 2026 market, head over to foundationcapital.ca. I'm Mit Perin. Thanks for watching, and make sure to subscribe for more insights from the front lines of Ontario private real estate.